Hello friends and welcome back to our channel. Today we have an in-depth tutorial lined up for you to discuss one of the most crucial aspects of CFD trading, and that is the costs involved. We'll be delving into spreads, commissions and swaps. So let's jump straight into it. Alright, so I know that CFD trading can be quite the puzzle and that's why we're here today. First on the list are spot CFDs and futures. So spot CFDs and futures are like comparing instant coffee to a 10-year aged wine. One is quick and the other one might age you before it pays off. Moving on, first on the list we have spot CFDs, which are also known as cash CFDs. Imagine you're going to a market and you see an apple and you want it, so you buy it right then and there at the actual market price. That's basically a spot CFD. You can open the trade based on the current cash price, and the cool part is that you don't have any expiration date to worry about. For example, suppose you're engaged in trading the Euro-USD currency pair. With spot CFDs, you can buy or sell based on the prevalent market price at that very moment. You can rest assured that there are no concerns regarding expiry dates. Now let's talk about future CFDs. Think of these as a pre-order for the latest iPhone. You are not buying it now, you are buying it at a future release date. These CFDs allow you to trade on prices based on an underlying market, like indices and commodities, but there is one catch. They come with an expiry date. Imagine you're trading CFDs on oil. A futures contract would specify the price of oil for contract expiry at a future date. As the expiration date approaches, the market price may fluctuate. But what's the real difference between spot CFDs and future CFDs? Spot CFDs typically have tighter spreads because they're based on the current market price, which is relatively stable. Don't know what spread is? Well, it's the gap between the buying and the selling prices. On the other hand, futures often have wider spreads. Why? Because there's more uncertainty about future market conditions. Lastly, the trading style matters. Spot CFDs are a hit for intraday traders, as you have to be aware of swap charges if positions are open overnight. Futures, on the other hand, don't rack up swap charges. They're more suited for traders looking to hold positions for more extended periods. Okay, so now that we have the spreads, we are going to think of them as the difference between the buying and the selling prices at the exact same moment. Simple analogy would be buying a car from a dealership. They give you one price if you want to buy a car and another price if you want to sell that exact same car. And the difference between those two prices is what we call the spread. Because the goal of the dealer is to make money whether you're buying or selling a car. So there will always be some difference between those prices. So how do we measure spread? We measure spread in something called pips. Pips are very tiny price increments. They're even smaller than cents. For example, when you're trading Euro-USD, think of that car dealership example. You obviously have two prices. One of them is the ask price and the other one is the bid price. So the ask price would be what you'd pay if you want to buy it in a store, and the bid price would be what you could sell it for if you were trying to sell it. For example, let's look at Euro-USD, so Euro versus US dollar. Let's say this pair has the ask price of 1.08548. and the bid price is 1.08542. So the spread in this trade will be the difference between those two prices, so 0.6 pips. But the kicker is that when we say 0.6 pips, it might not seem that much. But in this case, it doesn't mean 60 cents. It actually means $6. To calculate this number, you will need to multiply that spread in pips with the actual pip value, which for Euro-USD is $10 a pip. And this is for all pairs where the US dollar is the quote currency. So the size of the spread very much matters because it directly affects your trading costs. So a narrow spread is like getting a good deal, and a wider spread is just more additional costs. So if you're a frequent trader, more specifically a frequent scalper, then having smaller spreads will definitely help you maximize your profits. So is spread just spread? No. We have two types of spread. The fixed one and the variable one. The fixed spread, as the name suggests, stays the same no matter what the market conditions are. The variable spread will change depending on how chaotic or calm the current market conditions are. So what makes spread change? We have a list of different factors. Think of it like weather conditions for trading. So market liquidity, trading times, and big economic events can make spreads wider. So to keep your spread costs at a minimum, or let's say just in some normal ranges, you have to be very careful what broker you choose. Also consider trading when the market is buzzing, so when there is a little bit more liquidity, because that's when spreads are typically tighter. Okay, now let's talk about commission. Commission are like service charges at some fancy restaurant. It's basically the cost of doing business. And in CFD traders, brokers charge those costs with every single position that you're opening. But there isn't actually any regulation for the brokers to decide on how much commission they take. Every broker can take a different amount of commission. Some brokers have a fixed fee per trade, others may structure it based on how you trade. So if you're trading in high volume, it's best to contact your broker and see if they can cut you a deal on your commission. Also keep an eye for brokers that give discounts or special rates based on your trading volume. Last but not least, let's talk about swaps. Swaps are basically interest rates which are charged if you keep a position overnight. For many traders, swaps are actually a mystery on how they are being calculated, so we're going to do one simple calculation with you. Imagine you're engaged in Forex trading and you make the choice to maintain a position overnight. The interest you earn or owe depends on the direction of your trade and the interest rate difference between the currencies involved. For instance, when the interest rates in the United Kingdom surpass those in America and you're holding a long position in GBP USD, representing British pounds, you can earn interest by rolling over your position to the next day. On the flip side, if you're short in GBP USD, holding dollar, you'll find interest debited when you roll over your position. So how to calculate the swap? It's all about the interest rate difference between those two currencies you're trading. This differential determines whether you'll receive or pay. Now let's get practical. Here's a step-by-step guide on how to calculate swaps on an open position. Step 1. Log into your MT4 or 5 platform. Step 2. Right-click on the instrument you want to trade and navigate to Specification. Step 3. Under the specifications, locate swap points listed as swap long or swap short. And there you have it. You can now check the swap rates for your specific currency pair. Let's take the GBP USD swap rate as an example. In this case, the trader will receive a credit of $0.032 on keeping a short position open overnight, and he will pay 89 cents as swap charges on keeping a long position open overnight. So now we've covered the essential parts of CFD trading, including spot and future CFDs, as well as analyzed the costs like spread, commission, swaps, and triple swaps. You need to understand the costs of trading so you can prepare and choose the right broker for your trading style. Stay tuned for our next video because we are going to continue to explore the world of trading. And if you like this video, then leave it a thumbs up, share it with one of your friends, and hit the subscribe button to never miss any videos. Feel free to leave any questions you have in the comment section and tell us what topics you're most interested in and what keeps you away from being a profitable trader. Thank you for watching and see you in the next video.
Hola Prime, trade with transparency.